Hello everyone, I am Monika Yadav and welcome back to our channel. Today we are diving into some significant changes in the long-term capital gains tax affecting real estate in India. In this video, we will break down what these changes mean, including the new choices for tax rates, the concept of indexation, and how it all affects your real estate investments. In a surprising turn of events, the government has responded to public outrage over the recent budget proposal to scrap indexation benefits on long-term capital gains or LTCG. After hearing from taxpayers who were concerned about this change, they have decided to offer a new choice. Now, if you sell a property that you bought before July 23, 2024, you can opt to pay a 20% LTCG tax while still benefiting from indexation. In addition to the new option for LTCG tax, the government has also introduced an alternative in the budget. Taxpayers can choose to pay a reduced rate of 12.5% on LTCG without the indexation benefit. According to the amendments presented in the finance bill, taxpayers will have the flexibility to select the lower tax amount from these two options. The recent changes are seen as a big step back from the government's earlier plans about taxes on long-term capital gains for real estate in the budget. The government had argued that even though they removed the indexation benefit, they were bringing it back for properties bought before the budget. They believed that the lower tax rate of 12.5% would be a better deal for most people. However, this proposal faced a lot of criticism, with many real estate investors and property owners asking for relief from these tax changes. However, the amendment clarifies that for properties purchased after the cutoff date of July 23, 2024, only the new regime will apply. This means that buyers will face the LTCG tax rate at a rate of 12.5% without the benefit of indexation. So let's break down what indexation really means. Indexation is a way of adjusting the original purchase price of an asset or investment. Why is this important? Well, it helps taxpayers counteract the effects of inflation when they pay taxes on capital gains. By revising the cost of acquiring an asset upwards based on inflation over the time it was held, taxpayers can potentially reduce the amount of taxable profit they report when they sell. With these amendments, all properties purchased before the budget presentation date of July 23 have essentially been grandfathered. Initially, the original proposal did not include grandfathering for properties bought after April 1, 2001. For those properties purchased before that date, the fair market value as of April 1, 2001 was set as the cost of acquisition. In simple terms, grandfathering is a provision that allows an existing rule or law to remain in effect for certain situations up to a specific date, while any rule or law takes effect for situations occurring after that date. It is important to note that the recent amendments have reinstated the indexation benefit specifically for immovable property. However, this benefit does not extend to other unlisted assets such as gold. When it comes to unlisted securities or shares, the capital gains tax will be set at 10% for transfers made before July 23. But for any transfers on or after that date, the tax rate will increase to 12.5%. So while property owners are getting some relief with indexation, those dealing with unlisted assets will still face different tax rules. One of the main worries about the budget proposal on long-term capital gains tax was that it could lead to much higher taxes for people trying to sell their properties. In response to this anxiety, the Finance Ministry and Income Tax Department issued several clarifications to reassure taxpayers. The government argued that the new LTCG tax regime, even without indexation, would still be advantageous for most taxpayers. They noted that typical real estate returns generally range from 12% to 16% per year, which is considerably higher than inflation. The Income Tax Department indicated that only in cases where returns are below 9% to 11% per year would the previous tax rate be more beneficial, and they suggested that such low returns in real estate are quite rare. Meanwhile, the government clarified that rollover benefits remain intact. This means that if capital gains are reinvested in Section 54 EC bonds or used to buy or construct residential real estate within certain limits, those gains will still be exempt from tax. Despite the government's claims that the simplified long-term capital gains tax system would be helpful for most people, there were still concerns. A major criticism was that there was no protection for properties bought in the last 24 years. Many people wanted all properties purchased before the budget announcement to be exempt from the new rules. In response to this demand, the government has now made changes to the finance bill to include grandfathering. There were concerns that the new tax system, which doesn't include indexation benefits, may lead to more frequent sales of real estate in the secondary market. This could happen because people might not want to keep their properties for longer than 3 to 5 years. Additionally, some industry experts and opposition lawmakers had raised worries that this new regime could encourage more cash transactions in property deals. Sellers might be tempted to underreport the actual sale price on paper to reduce their tax burden. And that brings us to the end of today's discussion on the recent changes to long-term capital gains tax and their implications for the real estate market. Thank you for joining me today. Be sure to tune in next time for more insights and updates on finance and economy. Until then, take care and goodbye.